Welcome, everybody, to this week's Prepare for College podcast. My name is Chuck Moore, and I'll be joined with Al Hoffman and Gary Carpenter. Our podcasts are designed to inform families of college-bound students about financial aid, scholarships, and paying for college without incurring massive college debt for the family. Now, today we're digging into a big question families always ask. Do my savings and assets hurt my child's chances of getting financial aid? Well, some assets do count, others don't. And here's the surprise. Parents' assets usually count for a lot less than the students' assets. So I'm going to let Al and Gary break this hot topic down, and it will help majority of the families out there avoid common mistakes when completing the FAFSA. They will walk you through 6 of the most common assets families have and explain how each one affects the FAFSA. Al, what do you have to say by starting this out?
Okay. Uh, Probably the most contentious one. I know that people, uh, when they're running their families, have various budgets in the mortgage and retirement, and college, etc. Uh, and you kind of think about retirement as being not counted. It shouldn't count. And I agree. uh, the way it's set up is that your contributions are not counted anymore. And the actual volume or the actual principal of the dollars, the 401k or IRAs, Roths, etc., um, they're not counted either. So it is a good news in that the law changed 2 years ago or 3 years ago, and in the new law, the student aid index rules, the those retirement plans are not counted in, except for a couple of them. That's just the IRA and the SEP contributions are uh, are not counted either. So so it's a good place to go nowadays. These days, it's more balanced. I do believe it's the way it should be. So yeah, if you have
Al,
one, go ahead.
could you, I understand that's for the FAFSA, but could you tell us what happens with the CSS profile?
In the profile, there is in the main document or the main series of questions, there is there's nothing there that asks for retirement. Um, there is in what they call these supplemental questions. There's over 700 of them, and those could come up and have all kinds of questions about the retirement. So what does that mean? Well, Gary, it means that out of the 240 some colleges that use the CSS profile, maybe only 20 that are looking for that Roth and that 401k, et cetera. But that's if they do, it's in that special circumstance section. Excuse me, supplemental questions section. It's not in the main body of the profile to be counted. Um, so it will be asked, but it is not in the calculation as best as we can figure. So,
Sorry to interrupt. Thank you.
okay. Um, Now, if you take money out of a Roth to pay for college, that withdrawal shows up as untaxed income um, in your FAFSA. And it's so you got to keep that in mind. I mean, it's one of those things to I think if you're going to use those types of strategies, you should use them at the latter years of college and not the first years. So anyway, um, next up, let's talk about the home equity. So in the FAFSA, your home, it this is always surprised me. I have people who will fill out their FAFSAs, not like the results, and then ask me to get involved in helping them fill out their FAFSA. The first thing I go to is home equity because people, although it says in bold letters on the form, don't count home equity of your primary home, they still count it. So your primary home's equity will not be counted in the FAFSA. Not. Okay, now if you have a second home, that would be considered an investment. And investment real estate, again, the market value minus the debt, the equity, in other words, that will be counted in the as an investment. There is an investment line. There's cash. There's investments, and then there's business lines on the FAFSA. Those three are your asset sections of the FAFSA. So it will be counted there. In the profile, however, since you asked that question about the profile, we'll kind of go through that as we go through here. But the profile does count the equity in your home. Now, there are certain limits to it, but we're not going to go into the real deep details on that, other than say that they are looked at very strongly. All home equity, primary or investment, is looked at the profile. Now, let's talk about UGMAs and UTMAs. These are special things that have been set up for the student through the IRS tax codes, etc. Um, it gets they're considered as assets to the student. Counts these as student-owned assets. Now, parents' assets are going to be multiplied by a figure that's only 1/4 the size, tiny bit over 1/4 the size of the student. So it's best not to have these, but if you have them set up, it's kind of hard to undo legally. So it's just one of those things. If you did have the resources to create an UGMA or an UTMA, then that's going to go into your student assets section. Okay.
Let me ask you a question on the UGMA and the UGMA. There is a way, I'm assuming, that you can go ahead and transfer those over to a 529 plan. However, is there any tax consequences? Do you have to liquidate the investments and such to transfer that over to a 529 plan?
I do not know the tax ramifications of that particular strategy, although I have heard of it. I believe you're right. It can be done, but I do not know the tax ramifications of that.
Gary, do you?
I think maybe in those situations, depending on what's in the UGMA account, if it's stocks or bonds or things like that, and if there's any gains or losses, you're going to have to recognize those. But if it's just pure cash that's going from one account to another, think of it as one vehicle to another. We're getting out of a regular savings account and we're going to a 529 plan. If it's just cash, there's no tax ramifications. But if there are stocks, bonds, mutual funds that have gains or losses involved in it, when it comes out of that UGMA, you're going to have to sell them because they only take cash into a 529 plan. And therefore, if you sell something, if there's a gain or loss, you got to report that for tax purposes. A little
Yeah,
tricky there, but that's how that works.
that makes sense. Okay, Al, I'm going to give it back to you.
No, that's fine. That's fine. Uh, I did touch on it a couple of points earlier. Let's just make sure because it really is a basic number, but the student's assets from $1, very first dollar, are multiplied times 20%. So let's put some numbers behind that. So if you had $10,000 in the student's name times the 20% would be $2,000 increase in the SAI. Now, the SAI is really four calculations added together. This is one of them, the student's assets. The second one I want to talk about is the parent's assets. Similarly, that same $10,000 in the parent's name would generate $564 increase in the SAI. Now, if you had 10,000 in the students and 10,000 in the parents, remember I said four formulas. So here's two of them. And these two would create $2,564 increase, the 2,000 from the student and the 564 from the parent. So it's this is the issue where people that have substantial amounts of stocks and bonds and mutual funds, etc., and cash or CDs or money markets, this is where some of the college-trained financial planners will come up with some solutions that can ethically and legally move that money so that it does not show up in the formula. Just wanted to bring that up. Okay, so insurance policies and annuities, are they counted? All tax deferred issues are not counted, except for 529 and a Coverdell. So those are tax deferred, but they are counted. But the they're not counted if they are in insurance or an annuity. Once again, Gary, going back to that retirement question with the profile, there could be a supplemental question depending on the college that asks that question about a whole life value or annuity. Um, However, when you get right down to it, those three categories, the cash, the investments, and then the business value is what creates the three sections of the asset calculation for the student and the asset calculation for the parent. Now there's subsections, there's probably about, oh gosh, 15 items that you could take a look at by name. Uh, but those three sections, when you look at them, that's what creates that side of the formula's calculation. Um, Gary, you got anything else to add to that?
Yeah, I got a couple things, Al. Let's talk about stocks, bonds, investments that were mutual funds, things like that. And, if they're not in a retirement account, then you're going to have to report them as an asset. So again, if it's in the student's name, these assets are going to be uh, reported and assessed at 20% available for college costs. And as Al said, if it's in the parent's name, it's going to be assessed at 5.64%. So you can see the difference right there. But again, stocks, bonds, mutual funds that are not in a retirement account, they're going to be part of your investments that you're going to report on the FAFSA, and you're also going to report on the CSS profile. Now, there's one little thing you might want to pay attention to here. We talked about 529 plans last week, and there's also something called a Coverdell Educational Savings Account. Not widely used, but it's been around for 20 years. And I'm not recommending it. Don't get me wrong. I think the 529 is probably your best way to go. But both of these accounts have a special option under the FAFSA form. What I mean by that, whether they're in the student's name or in the parent's name, those assets are reported as a parent asset when filing the FAFSA form where the student is a dependent. Now, there's a lot of words I put in there, so let me cut it up and let you chew on it for a while. Regular FAFSA, the student files are a dependent, they report the parent's income and assets, okay? If there's a 529 plan owned by the student, there's a special rule that says that 529 plan is reported as a parental asset. Now, if the student's independent filing the FAFSA form, and what that means, they're classified by the Department of Education as an independent student. They don't have to report their parent information. In that case, they still get assessed at 20% of their assets, and a 529 plan that they own, that they're the beneficiary of. So they're on both sides of it. They're the owner and the beneficiary. That's an investment, and that one has to be reported as a student asset and assessed at 20%. So listen, I got way down here in the weeds here. I apologize that, but it's an important point I wanted to bring out. Again, 529 plans, uh, they can be a good investment. Uh, you can you can sock away money for college, and the earnings can be deferred or completely eliminated if they're used for college costs. I just say this, and I don't think too many of you will have this problem. Don't put a lot of money in a 529 plan. If you've got a student going to school and they're going to go to a school that's going to cost $300,000, don't end up putting $400,000 in a 529 plan. Try to estimate where the student's costs are going to be for education, and I would like maybe support 75% of those costs through a 529 plan. Don't put all your eggs in one basket, is what I'm saying. Chuck, anything
Gary,
you'd like to?
what if you only saved whatever 15%, 20% of the required cost to get your child through college? Would you use those 529 monies early in the game, or late. College is a 4-year process for most people. It could be a 6-year process for some, but let's just talk about the regular 4-year process.
And
Early or late?
I've always wanted to say this on a recording. I'm glad you asked that question, Al. Here's a situation, okay? You got 15, 20% saved for college, and they're in a 529 plan. When do you use them? Well, there's a few things you got to sort of balance out here. Rates are very high now. What you want to do is, okay, let's use our 529 plan with hopes that those rates may go down in the future. And I say those rates, the lending rates may go down in the future. If rates are low right now and you expect them to go up in the future, borrow now, use your 529 towards the end of college with where you believe interest rates are going to be higher. If rates are high now and we're hoping they're going to go down in the future, what you want to do is buy some time. Use the 529 plan money now and then borrow in the future with the hope that interest rates go down. So
I like
I
the way you put that. That's very clear. Let's base it on the rates. You bet.
okay. Chuck, I'm going to pass it back over to you.
All right. I'll just add something here. If you've got stocks, bonds, mutual funds, or whatever, you've got to realize also any of the dividends, distributions, or capital gains from these funds, they're going to have to be counted as income on your federal income tax return, which is going to increase your SAI. So just keep that in mind also. Well, as we just discussed, parents' assets don't hurt as much as you think. Students-owned assets can be a much bigger dent in your financial aid of your individual student. Now, if you're looking to save for college and you've got several years to do so, and I emphasize several years, the most aid-friendly place to possibly put your money that you can talk to your accountant, your CPA, or your financial advisor is normally into a parent's own 529 plan or cash value insurance or annuities. I would not eliminate those three from putting money in to help pay for the cost of a college education. Now, understanding how assets are counted can save your family thousands of dollars. So, with all that said, on this episode, be sure to subscribe to our website, prepareforcollege.com. That's prepare, the number 4, college.com. You can go to our YouTube channel, and it's youtube.com/the symbol at prepare the word for college, and you can look at the presentations through our YouTube channel. And also, please share this information with any other family members that are preparing for college. And join us next time as we continue helping you plan for a debt-free college future. So I appreciate everybody tuning in today, and hope everybody has a good day. Bye-bye.